Hello, I'm Andreas Bange, and today I will start a series about the accounting cycle. The accounting cycle starts with the transactions, which we will have to post into our two books. We have to report them in the ledger and the journal. Then we will close our accounts, we will balancing them out. With these balances, we can prepare our trial statement, we can prepare our cash flow statement, and we can prepare our income statement. And at the end, we will have our final balance sheet. Why is it called accounting cycle? Well, from period to period, it is starting over and over again. Today, we will look at records from investing and financing activities. The first thing we have to analyze in our transaction, what accounts are involved. In this case, we are having cash and capital stock. Second step, is this account increasing or decreasing? Well, cash is increasing, we are receiving it, and capital stock is also increasing because we are borrowing it from the owners. So basically the liability towards the owners is increasing. Then we have to post it into our journal. What is debit? What is credit? Well, here we have the world famous icon, the Bange icon, which can help us. Cash is an asset, so it is on the left side in the balance sheet, and you see the increase is on the left side. The code word for left, as you remember, is debit. So cash will be debited in the journal. Capital stock is on the right side in the balance sheet, so we will increase it on the right side. And the code word for right was credit. So capital stock will be credited in our journal. Now we have to transfer it, since it is double entry accounting, into the ledger, and that is easy. It's simply copy and paste. The same titles occur and the same amounts go on the same sides, spoken, debit and credit. That's it. Next transaction is then, again, we have to figure out what accounts are involved. What are the amounts? Are they increasing or decreasing? In this case, we're having cash increasing, and since we're not paying yet, accounts payable. Cash is on the left side, it is increasing, so we will debit it, and accounts payable is also increasing, so we will credit it. And the same we then post into the ledger. Next transaction, which accounts are involved? Well, again, cash and accounts payable. This time, cash is decreasing and accounts payable is decreasing. So when we see at the BANGEicon, cash will go into credit side and the accounts payable will go into the debit side. And both we also will transfer to the accounts cash and accounts payable. Please note here, we will keep the original T account for cash and for accounts payable. We will not add a new one. We keep it and keep on carrying and putting the transfers into one and the same space. That was the big advantage we have with the ledger. Next account, what titles do we have? Well, bank and accounts receivable. So bank is increasing, accounts receivable is decreasing. Again, you can see bank is an asset increasing, so we will debit it. And accounts receivable is also an asset. It is decreasing, so we have to credit it. So you can see it can also be two accounts of the same side in the balance sheet. Then we transfer it also into the T accounts and so on, so on. That's it for today. I hope you enjoyed it. Like it, share it, and see you next time. Until then, bye bye und auf Wiedersehen.